Good afternoon, everybody, and welcome to our first webinar of 2026. My name is Alex Hambley. I've been involved in the Vietnam markets for the last 20 years, and I currently serve as CIO to the Vina Capital Group. In my opinion, there's never been a better time to look at investing in Vietnam. We've always known about the potential, but what we're particularly excited about are the measures that the current leadership are taking to turn this into a reality. We believe that Vietnam is Asia's rising star and is now well set to become the next Asia tiger. In this environment, we believe there'll be many attractive investment opportunities for our clients, but we do know from experience, 20 years of experience investing, that the best approach is to be long-term and fundamental based. This investment philosophy applies to all the businesses within the Vina Capital Group, which, as you can see from this slide, comprises three clusters: energy, real estate, and asset management. For today's webinar, we're going to be focused on the public equity component of the asset management business. And for this discussion, I'm going to be joined by Can Vu and Tu Ning, the two managing directors of the business, who respectively manage our two offshore funds, VVF and VOF. Please look to your inboxes. The fact sheets for December will be out soon, and you'll be able to pick up a lot of the detail that we may not be able to cover in the time available today. We much appreciate the feedback that we get from participants, and as a result of the feedback we had from our last webinar, this time around we are going to make some changes, not least reducing the time that we spend. We're aiming to do this in 30 to 35 minutes. We also much appreciate the questions that we get, and for things that we can't cover in the time available, please do send us your questions and we will answer them. However, as usual, we always place a lot of importance on the macro environment. Michael Coccolari, our chief economist, has prepared his outlook for 2026, and that will be going out after this webinar. So please, again, look to your inboxes. As usual, we'll start with Mike Coccolari, our chief economist, giving a summary of his views on the economy. Mike, thank you.
Okay, Alex, thank you. All right. Vietnam's GDP grew by 8% in 2025, and the government set a very ambitious 10% target for 2026. Now that growth in last year was very impressive. That's very strong GDP growth even for Vietnam. But in order to get that growth, the government did some really aggressive stimulus measures. At some point, they were pushing on the gas pedal so hard that the consequence was some significant depreciation in the value of the dong, and also some disruptions in the interbank market, where banks lend to each other and interest rates reached as high as almost 10% on some days. Now, part of what that surge in the interest rates was about was that the credit growth last year was almost 20% in Vietnam. That's what it took to get the 8% GDP growth. So in recent days, policymakers have come out and they've said, hey, maybe we want a more stable, calm environment for 2026, macro environment. And particularly, we want credit growth to be closer to 15% than 20%. So what you see is the policymakers are facing a trade-off that often comes up in emerging markets, which is this growth versus stability trade-off. They're trying to navigate that. And that's where that focus in recent days on macro stability has come up. That having been said, we think another thing that's going on is that there's a cohort within the government that's saying, hey, we should focus more on long-term, making reforms for the long-term structural growth in Vietnam, rather than just trying to go for it on short-term, get very high short-term GDP growth. So that's kind of a picture of what I'm going to talk about today. Let me start by talking more about this 10% GDP growth target and then the recent guidance for a 15% credit growth. I've tried to represent this situation in a cute little cartoon here we're calling Schrodinger's economy. Those of you that know, there's this pop thing called Schrodinger's cat. It's just from quantum mechanics, and it's pop. There's a sort of lot of pop science thing around that. And the idea of Schrodinger's cat is that there's a cat in the box. You can't see in the box, and the cat is either one condition or another. It's very digital, either or. And so what we're trying to represent here is this idea that the 10% GDP growth target is not compatible with the 15% credit growth target. In Vietnam, the so-called credit intensity ratio is over 2x. So you can't get 10% GDP growth Actually, you can't even get 8% GDP growth with 15% credit growth. So when we make our economic predictions, what we do is we make like a baseline, our base case, and then we say, well, this could happen, that could happen, this could be a little faster, this could be a little slower. But in this case, this year, it's almost like a seemingly mutual exclusive forecast that we have to make. Our past forecasts are very accurate, as people that follow our work know. But what we're set up here is a seemingly mutual exclusive situation. So I'm going to tell you more details about the current situation and how we're thinking about it, how we're resolving how to think about that in our minds. So very aggressive GDP growth target. Until recently, the government has been talking a lot about taking measures to boost the real estate market. We were expecting that this would be a year where there would be a torrent of new real estate development activity. However, given that this more tempered credit growth target, and also that surge in credit growth, that has caused interest rates to go up by about one percentage point. And so if you think about it, 11% mortgage rates in Vietnam is not enough to derail the real estate market, but it's a high enough level that buyers, it gives them pause before they actually purchase. So this is another thing that we need to keep in our mind. So this, on the left of this slide here, this was kind of what the focus was in October, November, even in the beginning of December. You may know that this Resolution 68 was one factor that pushed the share price of Vingroup up more than 700% this year, or last year, and that's something we're going to talk about in the stock market section. But recently, we've gotten guidance also from the government to, hey, don't forget about SOEs. So when you look at this picture, it almost seems like they're sort of pushing on the gas pedal and the brake at the same time. So I want to tell you how we're thinking about this, how you can resolve this. We actually think that this year, in 2026, both of these situations are going to happen. We think in the beginning of this year, the focus will be on macro stability, keeping the FX rate stable, keeping the interest rate stable. But that objective of keeping the 15 to 16% credit growth rate is not compatible with reaching even 8% GDP growth. So I think what will happen is by the middle of the year, you'll see that policymakers feel more comfortable, maybe even a bit more compliant, you can say, but they won't be able to reach the GDP growth target with that low credit growth. And I think they'll start stepping on the gas again for credit growth, and I think you'll see a booming real estate market in the second half of the year. One thing I should make clear is that the issues with the foreign exchange depreciation and the interest rate, that was happening in the middle of December. We made a prediction that by now, the middle of January, those issues would pass. That prediction turned out to be correct. But we think that those issues are still in the minds of policymakers, and that helps to explain the refocus on more stability. Now, here's some more. What I want to talk about next is we need to, in order to understand 2026, we need to talk a little bit about what happened last year in 2025. The two main factors that boosted growth last year were exports to the US, high-tech exports, laptops, and these kind of products up 80%. By the way, that's up 80% not from a small base, so that's a pretty amazing accomplishment. And also a full resumption of Chinese tourists to Vietnam, up over 40%. If you take out these two factors, GDP growth in Vietnam in 2025 would have actually been a lot lower. Here on this chart, you can see that exports started rebounding from the middle of the year. This is the so-called new export orders index of the PMI. So it really started recovering from around the middle of last year, and that went along with this export story to the US. It looks like it dipped in December. This is actually a weather-related issue. You don't need to worry about that. This number will go back up in January. I'm quite clear about that. I'm also pretty clear that the tariff issue will kind of go away as the year progresses. There's been some news on that topic the last couple of days. You don't need to worry about that. The tariff issue, I'm pretty sure, will be kind of gone by the end of this year. And assuming that happens, what we should expect is that Vietnam's exports to the US, which were very, very high last year, very high growth, will come back down to normal. Tourist arrivals, the growth was very, very high last year, will come back down to normal. But offsetting that, you will have domestic consumption in Vietnam last year was actually pretty weak. It was about 5%. So if you look at the numbers that the government presents, they look healthy, but you have to remember that we had a surge in tourism. If you strip out that surge of tourism, domestic spending last year grew at about a 5% pace. That's weak by Vietnam standards, usually 8-9% pre-COVID. And the other thing that we expect, so we expect that to recover by the middle of this year. And the other thing we expect is that last year, there was an enormous surge in spending for infrastructure. Some of that money will hit the economy this year. So here's, regarding the consumption story I just mentioned, long story short, households in Vietnam, they depleted their savings during COVID, and what's been happening since then is they've been saving at a very elevated pace to try to rebuild their savings. Now their incomes are growing 6 or 7%, so that's healthy. We think that by the middle of this year, by the middle of 2026, there will have been 3 years of elevated savings. We think that will be enough time for households to have rebuilt enough of their savings that they feel comfortable spending again. So look for that to start happening in the middle of next year, this year, 2026. Also, U.S. economy is going to be stronger than most people expect. That will help support Vietnam's exports to the U.S. Circling back to the growth versus stability topic that I raised before, credit growth in Vietnam was over 19% last year, but deposit growth was only 15%. So bank analysts look at something they call the loan to deposit ratio, LDR. If you calculate the LDR in a very kind of simple back of the envelope type way, what you would see is that Vietnam's system-wide LDR for the whole banking system went up by about 5 percentage points last year. That's a big increase for 1 year, and it's currently around 110. 110 LDR for a banking system, even in emerging markets, is a very high number. And that's part of what caused policymakers to start thinking through, hey, maybe we should focus more on stability and more tempered credit growth. That differential between credit growth and deposit growth pushed up interest rates, I mentioned that before, but it also resulted in some serious liquidity problems for some particular banks. Now, what I'm trying to show on this slide is how did the SBB navigate those liquidity issues that came up. This is, again, particularly in December. And what you can see here is that the SBB trickled out liquidity to the commercial banking system via the so-called OMO channel. What I'm trying to show you here is that the SBB navigated this growth versus stability trade-off that they were facing in a very measured, very kind of professional way. Lending from the Vietnam Central Bank to commercial banks hit an all-time high, but you can see it was in a very measured way. They didn't just sort of dump liquidity into the market all of a sudden. There were people last year in December that were quite concerned that we could have a serious liquidity crunch in Vietnam this year in 2026. Let me tell you that Vietnam Central Bank is about 25% of the GDP here. That compares to 35% for our peers, so you don't need to worry. The central bank has tools that they can use to solve a liquidity problem. Also, the government has about, call it 40, 50, maybe $60 billion of its own money that's deposited in the central bank. They could easily take some of that money, move it back into the commercial banking system if there were a severe liquidity crunch, and solve the problem instantly. So you don't need to worry about a liquidity crunch in Vietnam this year. And finally, coming back to the topic of the long-term growth, these factors that have been driving Vietnam's growth will still be there, that were there for the last 10 years, will still be there for the next 10 years. But what will be new in the next 10 years is more focus on infrastructure, more focus on domestic-driven growth via these Doi Moi 2.0 reforms that we've talked a lot about and published some reports on. And also, I personally think one of the big things that will happen in Vietnam that I don't see a lot of people talking about is a build out of local supply chains to supply FDI companies. So currently the FDI companies import the majority of the parts that they use to construct product, electronics, this kind of stuff. And you'll see an industrialization effort in that arena in particular. Regarding the Doi Moi 2.0 reforms, these are meant to address Vietnam's structural issues. Here's 2 pieces of research that came out in recent weeks, one from the IMF, one from RMIT. The IMF looked at what's called total factor productivity, or economists call TFP. Basically, Vietnam's TFP growth is around 0%. For an emerging market economy, it really should be 3, 4, 5%. So the hope is that the structural reforms will address the issues with TFP growth. What the RMIT research is about is saying that the spillovers from FDI companies into the broader economy is, again, about 0%. So the government is taking some measures to address this. You know, when we have FDI companies here, it's good that we get employment, but we're not getting spillover benefits in terms of technology transfer and broader benefits to the economy. So the hope is that the Doi Moi 2.0 reforms will address that. And we think, and I think the IMF also agrees with this, that if the reforms happen the way we're thinking they will happen, they would boost Vietnam's long-term GDP growth potential by about 2 percentage points. So that's everything that I wanted to tell you about the economy. And what we're going to do next is we're going to have a discussion about the stock market. We're going to bring up some chairs and have a panel discussion. So just bear with us for a minute, and we'll be with you in a second.
Okay, as we've done in the past, what we want to now do is go to a panel discussion on some of the main topics that we're seeing in the marketplace. There are 4 things that I really want the panel to discuss. The first is around markets and performance. The second is around valuations and earnings growth. Thirdly, I think we should spend a little bit of time on sectors and what's going on in the sectors. And then lastly, there's a lot going on in the world at the moment and in the market, so I'd like to think a little bit about market events and how that might be impacting the markets over the next year. When we've done that, and I think we should try and keep that to 20 minutes or so, I'd like to go to a quick lightning round and ask each of you to share an observation for our participants, one thing they can think about as they go into the new year. So what I'd like to start with is markets and performance. Maybe Tu, we start with you, and then KB, if you've got anything you want to add to that, please do. And Mike, for you, always jump in if there's anything you feel needs to be added. Tu.
Thank you. So actually last year in this January webinar, Mike made 2 predictions about the market, both of which turned out to be true.
Well done, Mike.
First one being the market will enter into a roller coaster year in 2025, and it did, because the market experienced one of the highest levels of volatility in its 25-year history, with a 20% of the cliff when Trump announced the 46% tariff, to the 50% rally afterwards. However, he also made a prediction that the market would end the year significantly higher than 2024. And again, it did, because 37% return was quite impressive and placed Vietnam amongst the top performing markets in the world.
Although I didn't expect that much of an increase.
Right.
Outperformed.
Yes, I was going to say that what neither we nor the market could predict was how narrow that performance would be. And it's also the first time we've seen just a handful of stocks could drive over 3/4 of the returns of a $300 billion market.
Okay. And if we think a little bit about that, there's some numbers we can put around that in terms of how many companies were driving this as a percentage of number of stocks on the market, and what was the differential range between the 2 outcomes?
Yeah, so if you think about how the market performed last year, and Tu said 37%, and it's really a story of 2 halves. I mean, Mike, the first half of the year with the Trump tariffs, the index was up only about 7%.
Yeah.
And yet the second half of the year, you saw the index up 30%. And similar to the US market, and we draw parallels to that, it's been driven by a very narrow group of companies.
Yeah.
In the US, you think about it, it's concentrated, it's been narrow, and it's been persistent. And for Vietnam, a very similar dynamic has come to play. So if you think about what's been driving the market in the second half of the year, the conglomerates and particular companies like Vingroup have really pushed forward market performance. And as Tu mentioned, almost 3/4 of the market performance has come from this very narrow group. Conceptually, if you sort of strip those companies out of the index, then the broader market is up only about 10%.
Right, okay.
Yeah. So if you think about performance, likewise, our performance of the year is a story of 2 halves. Calendar year, first half flat, impacted by uncertainty and tariffs. The second half, we're recovering performance. And I think later on we'll talk, as we go into the opportunities, as the market has increased, we've seen a much broader scope of opportunities to invest into.
Okay. All right. Mike, do you have anything you want to add to that?
I think they nailed it, yeah.
Okay. So that is sort of what the market has done. Where does that leave us in terms of valuations today? And as you think about valuations within the context of the earnings growth of the market and the companies?
So at the moment, the market is trading at 13 times 2026 PE. But stripping out the Vingroup stocks, which are arguably the most expensive after a phenomenal run last year, the market valuation would be just under 11 times, which is the 5-year average.
It's a 5-year average.
So I would say relatively attractive. And then if you look at our portfolios, which are all actively managed, the valuations are even lower, at just 10 times, against earnings growth prospect of 18 to about 21%.
So that's a very attractive PEG ratio, well below 1.
Yes.
Oh, yeah.
And that earnings growth, how is that even across?
I think this year what we are looking at is that the growth prospect for the market is very positive, with growth being spread out across the sectors. Most of the sectors are expected to deliver between 15 to 30% earnings growth.
Okay.
And some highlights include insurance,
Yep.
benefiting from low penetration and rising interest rates, and brokers benefiting from higher liquidity in the market, especially with the upgrade. Even the banks, which are basically the biggest sector in the market, and facing some challenges this year, including NIM compression and lower than expected credit growth quota given by the state bank. We still expect the banks to deliver about 17% earnings growth.
Mike, your thoughts on the banking sector? And
Yeah, the NIM compression is alluding to something I mentioned earlier in my presentation about the interest rate, last year's credit growth versus deposit growth. But I still think that the prospects for banks in particular are very good this year.
Yeah, so if you think about coming back to the market outlook and performance and sectors of growth, within the market, financials still dominate. They're the largest sector in terms of market weight. And within our respective portfolios, what you'll find is financials are also well represented. For VOF, for example, almost a third of our portfolio is into banks, primarily into commercial banks. Last year, last year meaning the end of 2025, Tool mentioned here that brokerages are seeing some really good earnings growth because of the liquidity, the market upgrade. We saw a tremendous amount of fundraising, new fundraising activities, and that allowed us to step in and look at several of these opportunities. So if you think about in 2026 now, our research team is expecting earnings growth for 2026 about 18%, well above regional peers.
that's an average across sectors.
Average across sectors, right? And then if you think about within that, banks will be about in line with that, about say 17%. Real estate will continue to perform. We had a very tremendous run in the real estate sector towards the second half of last year. Vin Group and Vin Homes driving a lot of that performance. For us,
although the cooling measures that have come in recently, does that impact the real estate?
We'll see. I think, as I mentioned in my presentation, things will look kind of cooler in the beginning of the year, and then in the second half of the year, they'll step on the gas pedal again. And by the way, even if it's a good point you're making, but irrespective of that, given that pre-sales doubled last year, there's kind of an automatic read-through to revenue and earnings, irrespective of these cooling measures.
Yeah, I mean, we've just had a discussion with our largest holding the portfolio, Kangdin Homes, leading real estate company. They just announced this year they're expecting a very strong performance in their earnings growth. So again,
because they got the pipeline, they can see what's coming.
Right, and the licensing. So for us, real estate will still remain a very important sector, and will drive some of that performance. But I think what's important now is thinking that broader growth. Last year we talked about this narrow and concentrated growth. This year
it's going to spread out.
It's spread out more.
By the way, just like the S&P 500, it's also spreading out, seeing a similar phenomenon
Just
here.
one last point on valuation and growth. I think just on valuation and growth for the market and for the sectors alone this year, they already make the market very attractive. But considering how narrow the market was last year and how some of the best performing sectors in terms of earnings growth delivery did not perform. I think that gives us the optimism that some of these good stocks would play catch up this year.
Okay. For me, I think the consumers, if you look at the steps that some of the companies did last year to build out their the distribution channel, they sort of sacrificed a little bit of their earnings last year, and you'll see them, do some kind of catch-up rally this year.
I mean, this is all very positive, but one of the things that we hear sometimes with people coming in is China and what happens to China real estate. So I know, Mike, maybe you could share
my favorite topic.
Your favorite topic, but I think for people listening in, we're positive about real estate, but they will be aware of what's happened in China.
Sure, that's a great point. So we've published many reports on this, starting with the Evergrande, that became more of a focus. The first thing I'll tell you, the first thing you need to know is that the vacancy rate in China is over 25%. The vacancy rate in Vietnam is less than 5%. And actually, if you look at the vacancy rate for apartments for normal middle class consumers, it's essentially 0%. We have a very different situation in Vietnam compared to China. The amount of real estate supply in Vietnam has basically been half the demand for years. So it's kind of a quirky situation that prices went up around maybe called around 30% last year, certainly 50% since 2023, but it was driven by a lack of supply. So it gets back to your point about KDH. These guys have got a fabulous pipeline. Completely different story than China, and looks really good, I think.
Yeah, and I think also within Vietnam, banks and real estate, very, very correlated sectors, but we have some really prudent management around credit growth around that sector. So we're not.
And this comes back to the leadership point I was making earlier. The confidence we have in the current leadership to apply good common sense to how we manage the economy. Would that be fair?
Also, I think it brings out the point that the corporates are generally deleveraging to manage risks. And I think against the backdrop of attractive BEG, we also observe that I think more than half of our investment universe have ROE over 15%.
Great. Okay.
So that makes
with
the
low
market,
leverage, by the way.
Yes,
Debt
so
to equity
that
around
makes the
zero.
market very attractive.
Around 0.5 debt to equity for the market. I mean, it's not a highly levered type situation.
But KV, you made a comment there about the market and the emphasis on real estate and financials, which I think most people are aware that it's quite limited. The Vietnam market relative to other markets is quite narrow in that regard. Are we talking about the great opportunities in the country and the growth? What are the other sectors that perhaps are not represented on the stock market here, which I think is a big feature of the country? And what are the other areas that you're looking at?
And a feature of how we execute our strategy.
Yes.
Right. I mean, we're an opportunity fund, and that opportunity allows us to look at private opportunities, privately negotiated opportunities, as well as public markets. Admittedly, a lot of our portfolio today is public equities, right? But many of those have come through the pipeline as private equity or privately negotiated. So what are we looking at the moment? So beyond the typical real estate and financials, where we find sectors that are underrepresented in the index, healthcare, that's an area that we've been focusing a lot on in this portfolio. We've invested over the 20 years into 4 healthcare platforms and been able to successfully exit 3 of them. The pipeline of opportunities still is very interesting in the healthcare space, whether it be hospitals or clinics or other healthcare ancillary services. So our team is really active in that space at the moment. And if you think about index weight, it's less than 1%, right? I mean, a couple of generic pharmaceuticals, 1 hospital group. Whereas if you think of our portfolio, it's about 6% of NAV.
Okay.
And of course, healthcare is the thing that people want, emerging middle class consumers want when they get the first thing they want.
And within that, so how we package that healthcare exposure, it comes under this idea of consumer spending, right? So within our portfolio, while we have financials, while we have real estate, consumer sector, including healthcare, actually represents almost a third as well. So,
okay, but the consumer sector, Mike, I think you've said in the past you were expecting it to increase, and perhaps it hasn't as much as you were expecting.
Yeah. Well, no. I'm expecting it to pick up from the middle of this year.
Right.
And the way to look at that.
What's going to drive that?
Yeah, the way to look at that is households depleted their savings during COVID, and they've been saving at an elevated rate ever since then. Their incomes are growing around 6 or 7% a year, so that's healthy. We think that by the middle of this year, by the middle of 2026, you will have had about 3 years of elevated savings. That should make households feel comfortable, that they've rebuilt enough of their savings that they feel comfortable to save. Last year, the spending by local domestic consumers grew by about 5%. Actually, that compares to something like 8 to 9% growth pre-COVID.
So both of you would expect that feature to flow into the performance?
Yeah.
The consumer sectors are actually very underrepresented in the VN index. Together between consumer staples and discretionary, they are around 10% of the index. But we have a very overweight position, a large overweight position in this space, because there are opportunities to pick stock within this group of companies. And especially the consumer discretionary companies benefiting from the structural shift towards modern retailing. And the top retailers, on the back of economies of scale, are gaining market share as well as achieving better operational efficiencies.
Okay.
For instance, Mobile World, which we both have in our portfolios in big position, last year delivered close to 50% earnings growth. And this year I expected to have another 24-25% earnings.
Very strong, yeah. And I think absolutely that the opportunities in the public space also translates into the private space, right? So for us, we've been a long-term investor in this sector over the years through either privatizations of companies. Vina Milk is a great example that 20 years ago privatized. We got in early. And then, we've got also other opportunities where you see homegrown domestic companies growing. And I think that coupled with the policy changes and the reforms that have been taking place. Last year, you heard us talk a lot about this Decree 68 and the promoting of the private sector. That creates a lot more opportunities for these companies, particularly in the consumer sector, to really benefit from an environment whereby they can operate competitively against regional global companies, can go to market, get licenses, operate in an environment that is equitable to other.
And we are seeing examples of Vietnamese companies expanding. Sure. Indonesia, India.
Yes.
Yeah. Okay. I'm just keeping an eye on the clock, and we're talking about some of the fundamentals there, but what I also wanted to have 2 or 3 minutes on is some of the market events that participants can watch out for or start to think about. And in my mind, I'm thinking about things like upgrades to the market. We're starting to see more IPOs coming. Any thoughts on general market events that our viewers can think about?
The market upgrade is quite well covered by international
Yes.
media. And I think the outstanding items this year for Vietnam arising from the FTSE upgrade is the review round in March, which we think is a non-event because what needs to be fixed has already been fixed.
Right.
And then the official upgrade will happen in September of this year. But what we think is more exciting is the fact that the regulator is very progressive in addressing even some of the issues raised by MSCI, which means that MSCI emerging markets upgrade is imminent and will likely happen before the government's timeline of 2030.
2030 is their timeline.
Yes.
But we think that could be brought forward.
Yes, much shorter timeline now.
Okay.
And the flows estimated by FTSE is 1 billion in passive flows and about 5 billion or more in terms of active flows. But the flows by MSCI are expected
Much
to be
bigger.
much
Yeah,
bigger,
yeah.
and all of which are positive for
And
the
we've seen
market.
that in other markets around
Yeah,
the
you've
world.
seen in other markets, I mean, the MSCI upgrade can drive like a 50% increase in the index. That's not unusual.
But that drive actually is prior to that upgrade.
Yeah.
Right? It's not once you've got the upgrade and it's set. But a lot of the active funds, the ones that don't have to wait until the approvals, they can participate.
Yeah.
And one of the things that we've been sort of banging the drum about in recent years, and now with perhaps more clarity on MSCI, is for investors to be just to participate, right? Be invested into Vietnam, because if you want to get into this incredible growth story that is very unique in the region, if you want to access these companies that are either private or public companies, but have this room for growth into sectors that play into the domestic economy and potentially even go abroad, as you say, Alex. This is the market for you to be invested in.
So,
Yeah, well, it also speaks to the importance of being on the ground. Like this view that maybe the MSCI is going to happen before 2030. You only know that if you're here and you guys are meeting the people in the government and this kind of thing.
foreign ownership limits, another topic that comes up from foreign investors, and maybe what happened at our conference.
Well, I think if you were chairing a panel, Alex, where sort of the whole room sort of was in stunned silence, is October when one of the very senior folks in the regulators, the State Securities Commission, sort of really openly and casually, but very convincingly said, we are looking at lifting the foreign ownership limits, and this will play very important into how and when we upgrade. Right. So for us, Vietnam is going to be a market that is going to look a lot more normal form. And one of the things we always say is if you think about where Vietnam is today, with liquidity, the number of companies that are over a certain market cap, the improving disclosures, we are effectively an emerging market.
Yeah,
Right.
exactly.
Another upgrade that we are very excited about is the sovereign credit rating upgrade.
Very
Okay,
important.
well, this is an important point,
Yeah,
and
yeah.
I'm keeping
This
an eye
can
on
be
the
a
clock.
whole nother webinar, but long story short, We think that the government's ambitious infrastructure plans will require at some point that they focus on getting an investment-grade credit rating. We're just slightly below. And of course, the main thing there would be enabling the government to borrow in foreign currency. If you want to do something like high-speed rail, you're going to need more US dollars. But what we've also seen in the past is when you do an upgrade to a investment-grade rating, it benefits the stock market as well.
Yes.
So, and we'll be publishing a report on that in the next week or so, a couple of weeks.
And Alex, one of the things, we get asked about this program of growth of Vietnam, driven by public spending and other things, is where is this money going to come from?
Yeah,
right.
Exactly.
And so we started this year. We've talked to a couple of the banks and a couple of the real estate companies, and the view at the moment is that there is definitely scope for Vietnam to increase public debt as well as private debt.
Yeah.
We've been sort of this period in recent years where we haven't seen much activity in that area. Last year, we saw some activity, very encouragingly, around companies going to IPO and going to market to raise money. But I think this year, we're going to see another dynamic of raising debt through corporates or through public.
Government debt to GDP in Vietnam is less than 40%.
Right.
I mean, this is an amazing statistic anywhere in the world.
Okay. Let's try and pull it together. So thank you very much for your time, much appreciated, and thank you to our participants. But maybe for a bit of fun, we'll have a lightning round, as I mentioned. Maybe each of you could share one thought for our participants around the market, things that they should think about, or tips that you could give them. One thought from each of you to pull this together. Maybe ladies first, too.
I want to highlight to our international investors about how fast things are moving on the ground here in Vietnam.
Yeah.
Because of the swifter than expected government reforms, which underlie a major mindset shift. And that's very positive for the long-term growth. And we're optimistic that this alone could add maybe 1 or 2 percentage points to annual GDP growth for Vietnam.
Okay. So your point is speed of change,
Yes.
change of mindset. Okay. KB?
I'll extend that thought. And with that pace of change, you've got to have you've got to be investing into folks that are on the ground.
Yes.
Right? And you started this conversation about talking about the Vina Capital platform and how we access many parts of this market and the economy. And that allows us an incredible insight into that pace of change. And then it allows us to take action on those pace of changes. We've come through a challenging year in terms of performance and keeping up. But as we believe these reforms not only just benefit the private sector, but interestingly, now we've seen reforms that now benefit the public sector and state-owned companies.
Yes.
That pace of change is rapidly happening. We're front and center of that, and we believe that the platform for the improvement in performance across all strategies is really there for this point forward.
Thank you. Michael?
So this year, 2026, expect more calm in the FX market and the interest rate market for the first part of the year. And then in the second half of the year, I think they're going to step on the gas pedal again, and we'll see much higher credit growth, much more vibrancy in the real estate market towards the end of the year.
And thank you very much to everybody who has joined us. This webinar is recorded, and it will be on our website and available for people to watch. Other things to look out for in your inbox. I think, Mike, you're looking forward to 2026 note is imminent, and will go out in the next couple of days. KV, your fact sheet for VOF, with a lot of the detail around performance that we didn't cover today, and the same for you too, VVF. So please look to your inboxes for the fact sheets. I'm not sure there's anything else. KV, you're in London.
Yeah, I'm in London early February. Right. So again, welcome the opportunity to do face-to-face interviews.
Okay.
Start off the year.
And otherwise, we'll keep you posted on other webinars and other events that we're hosting. Thank you very much.